What is going on, traders? In this video, I'm going to show you the exact strategies that allowed me to make almost $19,000 last week. You guys have requested this video saying that you want to see more trade recaps, not just my take on the markets and the economy. So I'm happy to bring those to you. If you get any value out of this, click that thumbs up and let me know in the comment section below what parts of this you found helpful and what things you would like to see for future videos. But I don't want you guys to focus on the money made. To me, that's not the important part. The important part is focusing on what makes a trade an A+ setup. What is my risk to reward and why you should always let your risk to reward play out? What is my reasoning for taking those trades? And if you stick around to the end, I will break down 2 more trades for you exactly in full detail, showing you why I took those trades. I think this is helpful if you guys are struggling with determining a strategy or really struggling with how to spot whether a trade is A+ or not. Now, you're not going to learn an exact strategy just from watching a 10 or 20-minute video, but hopefully I will spark the curiosity in your mind to look these concepts up. And if you guys are part of the academy, you know that all of my trades, my entries and exits are all posted in real time. They're all timestamped, so this stuff has a record of actually being called out. And if you guys want access to all of my trades, all of the courses, you want access to the Zoom calls with me where I go over this stuff in real time in our mastermind calls, answer all of your questions. Having such an interactive community in this regard, whether it's the mastermind calls, whether it's the live chat, we are on every single day pre-market until after market closes, having access to all of our trade alerts, not just mine, but the other analysts as well. All of my reasoning for which long-term investments I'm making, which ones I'm cutting, alerts on futures, options, stocks, and yes, even crypto. Make sure you check out the academy, book a call with one of the ambassadors, and if you're approved, you will know right away. Other than that, smash the like button. Let's get right into it. So the first trade I'm going to recap for you is the short that we had here on NQ futures. This was one that I got a lot of questions on social media, why I took it, how I took it. This ultimately ran for 99 points. Now, I did a whole video on how to trade futures for free. Check that out here. But if you don't understand how futures are priced, in short, on Nasdaq futures, 1 point equals $20. So 100 points is $2,000 per contract. Now let's look at the Nasdaq futures chart. What was the first thing that caught my eye? Well, during this day, I saw that we were rejecting off of VWAP. VWAP is this blue line here. I don't really use many indicators, but I do always have a few things on watch. VWAP is one of them. Volume profile is another, but I won't get into it in this video. Now, what is the first thing that I'm looking for? The first thing I'm looking for is what is my general bias, right? And you determine this by looking at longer time frame charts. So even though this is the 1 minute and I base my day trades off of usually the 1 minute, the 3 minute, or the 5 minute, I still want to zoom out and see what's going on. So I see that on February 28th, we created a high and then a lower high on March 1st, and we started dropping from there. So I'm like, okay, this might have been a liquidity grab, meaning we grabbed liquidity from the buy side, and we are now potentially heading lower. So if you look at this on the 15-minute chart, here was a high. And, you know, beginner technical traders will look at this, and as the price is moving into this high, so if we just do the replay thing, as the price is moving to this high, what are technical traders, especially beginner technical traders, what are they going to do here, right? They're going to look at this as a potential double top, and novice traders or retail traders are going to short from here. Well, where are they going to put their buy stops? Here's a very basic liquidity concept. I will do a whole video on liquidity later. But essentially, my trading has evolved over the years because I've learned to trade more so like the banks and institutions than retail. So if retail is going to go short here based on this potential double top, something that they learned off of a textbook or YouTube video, where are they going to place their stops? Well, all their stops are going to be placed up here, right? They're going to go short from here. And then their stops, which are in the form of buy orders, because when you short, you're selling to open. When you close, you're buying to close, right? So this is why this is called buy-side liquidity. These are all buy orders that are set up here as stop limits for traders that are looking to go short off of this double top. So what ends up playing out is the stops are basically hunted, right? And retail traders will tell you, oh, this is a conspiracy. You know, the institutions are out to get my stop limits. Yes, they are, because they know exactly how you think. And so This right here is institutions who also want to go short, right? Banks who also want to go short, but they can't find liquidity. Because if retail traders are going short here, and banks also want to go short from around that level, because from a technical standpoint, it makes sense, then where are they going to find customers who are willing to sell them orders? If all of the customers in the form of retail traders are selling here, where are they going to find customers who are willing to also sell them orders at around here? They're not, but they know that a lot of customers have their buy orders in the form of stops here. So this is where institutions are going to get their liquidity, right? Anyway, let's exit replay mode and go back to the trade. So I saw liquidity was taken up here, and now my bias is potentially to the downside. We made a lower high, as in a lower high than this, and it looks like we were starting to drop in the morning. So now I'm looking for retracements in order to ride this wave down. And if you take a look at the 5-minute chart, you will see that the bias also matches up. Here you see the price is making lower highs and lower lows. This is clearly a downtrend. So when I zoom into the 1 minute, I'm looking for areas of retracement back up in order to take this short. So my trade said I'm taking NQ short at VWAP and breaker. And I made a mistake here. I didn't mean breaker. I really meant order block, but that doesn't really matter. I will explain why I took this order short from here. However, I was scared of this liquidity level here. We had a liquidity level right above where I wanted to go short. Now, in hindsight, this wasn't an optimal trade. It was not an A+ setup. Still not bad because of the way that I managed this. But here I said first target 11,967, 11,949, and ultimately 11,927. My stop is at 12,023. If stopped out, we'll consider re-entry at 12,035.25. So if you look at this, I was looking to go short right here, which was at 12,015. Remember, this is the Nasdaq futures. But I said that my stop limit was going to be at 12,023. So really, I only gave myself 8 points above where I entered in order to stop out. And I was going to enter at 12,035, which was this area. Let me just open up my mouse pointer, this area of liquidity here. So you see I was targeting VWAP because that looks like where we were rejected during that bearish bias downtrend all day. And then also I pulled up a fib and I drew my fib from the top to the bottom to measure this uptrend. And we see that right around the level that I wanted to enter, we also had a very important fib level, which is the 0.618 fib level, right? We had VWAP, which is the blue line. And then also we had this candle. Now, in terms of order blocks, there is somewhat of a subjective nature to them, right? So without going into too much detail, an order block is basically an area of liquidity where institutions have moved price away from that in order to engineer the next move. When we see this green candle here, this is the last green candle before a major downtrend and before we actually broke structure, as you can see here. The price usually goes back to retest this block. And if it is a bearish order block, as in this case, the last green candle before a large move down, in the other direction, a large red candle before a move up is a bullish order block. You do need to confirm it with a market structure break. But in this case, this is an area of interest when the price retraces back up there to retest this level. So with that, the fact that we were at VWAP, the fact that we were at the 0.618 fib level, I expected the price to move down. Now, eventually the price did move down and we were up 20 points. Remember that on the Nasdaq, each point is worth $20. So that's about $400 per contract. And that was this move here. Now, what ended up happening was what I was actually afraid of. And I probably shouldn't have front run this trade. However, I did not want to miss a move down with so much confluence. For those who are scalping, we're okay with this 20-point move down. Remember, our stop limit was only 8 points above. And I'm a huge believer in making sure that you stick to your trade as long as the risk to reward is still there. If your stop limit is 8 points, it makes no sense to take profit less than that. Unfortunately, what I see a lot of people doing is they get scared out of their trade. So let's say that you enter a short here. So let's say that you enter a short here and you have your stop limit somewhere up here. Let's say that you have your stop limit at, 10 points. if you enter a short here and the price starts retracing, what people do is they panic and they see green. Let's say that your short is now profitable by 5 points. People will close this out in panic mode. However, you risked 10 in order to make that 5, meaning if price actually didn't reject from here where you expected it to and price kept going up, guess what you would do? You would stick to your stop limit and maybe even more. I've seen people, hold trades until they bleed. And so essentially you are risking 10 points in order to make that 5. And that to me is not a good RR. I try to maintain at least at the minimum a 1-to-1 RR, but at best a 2-to-1 RR or better, right? So in this case, if your short did work out and you risked 10 points where your stop limit was, you should not be taking profit less than 10 points on this trade. So when I look at this and I send out an alert that we were 20 points up, remember, we only risked 8 points because our stop limit was 8 points up in order to make that 20. So if you are a scalper, you should be happy with this type of risk to reward. Okay, so what ended up happening is that the price ended up going back up. We got stopped out, or I got stopped out. And then I ended up taking the trade from this area here. Remember, I said 12.03525. Now, why that? Well, because in my view, there was always a chance that we would come up and take this area of liquidity here, right? And that's essentially what we did, was that we took this area of liquidity and we were still around VWAP. As you can see, price rarely just stops at VWAP. Sometimes we cross above it and do sort of like a similar thing to a swing failure pattern. And if you are a supply and demand trader, well, you could see that here we have a classic supply zone, right? Based on all of this consolidation here. Furthermore, I pulled up the 15-minute chart to see if it was clearer. Remember, I'm not just going in between time frames for fun. I'm actually just looking to further the story. You should not be switching time frames unless you're trying to tell a more complete story. So when I look at this price action here, this is still where we are. Well, on the 15-minute chart, nothing has changed, right? We still see these sharp wicks showing that there is a lot of liquidity taken in the form of buy stops. And you can even see this on the 5-minute with all these wicks up here, right? So to me, the trade wasn't invalid, even though on the 1-minute we got stopped out, we re-entered. And again, if you look at this, I mean, depending on how you define your order blocks, some people will say that this tall green candle here is the order block, right? Because usually you want to look for the healthiest green candle before a downtrend. Some folks will say that this right here, the last green candle, regardless of how tall or short the body was, is the order block. To me, it doesn't matter, right? It's all about context. We broke structure, went back up to retest this area of liquidity here. And it is a very high risk to reward trade because our reward was, again, I was targeting, at least going back to this area of liquidity, which we eventually did. But our stop limit was right above where we entered, and it was after the banks had taken all of this liquidity. So that resulted in a 99-point move down. Again, almost $2,000. It was $1,980. And the reason that I took profits here is literally because we had this area of liquidity here, and we had a potential demand zone because we see this block here, even though not technically an order block, we see this block of orders here, which signifies a demand zone. And eventually the next day we ended up tanking way below this. So if you held this overnight, you made way more. But in my view, this was good enough trade. A great trade from a risk to reward standpoint. Now, as I said, I'm going to reward you with 2 more trades. One is Meta and the other one is Quantumscape. Now, the cool thing that I love about our group, there's a lot of things I love about our group, but one is the variety of trades that we are able to dish out because of our experience level. And me as well as the other analysts. And there are members that specialize in everything. There's members that are only options traders, or some that are only futures traders. But what I'm trying to get at is our variety of plays. So not only do you get futures trades like the one that I just highlighted, but obviously options plays as well, which a lot of people are interested in. But we also do outright shorts. I don't think there's any group that provides the variety of trade alerts and trade reviews using so many strategies, whether it's options, stocks, futures, etc. So in this case, I shorted Meta with shares and I shorted Quantumscape with shares. So let's go over Meta first. All right, so let's look at Meta's daily chart. A few things stood out at me. One, obviously, you have this huge gap up, right? That is initially what piqued my interest. We have this 23% gain after missing earnings, but they did beat on revenue, something that the market didn't expect. So this created an imbalance. However, we had an imbalance here already, and this is in the form of what we call a fair value gap. Again, it's a 3-candlestick pattern where we have a huge down gap in this case, and we take the low of the previous candle, the high of the following candle, and we have what's called a fair value gap. And so that is usually where the price retraces to in order to mitigate that price imbalance. So we have this huge gap here created, in my view, by an earnings overreaction. They beat on revenue. They also announced that they were cutting on their staff, right? So anytime a company does cut spending, you tend to see a imminent price boost that usually doesn't last a long time if there's nothing else behind it. Then I took a Fibonacci tool and I measured what the high was from the previous swing high to the swing low, and you could see that we are at the golden pocket level. So that is another point of confluence. Then you see all this liquidity being taken up here, right? You have these gaps not only on the earnings candle, but the one following it. And then you do have a doji on the one following that, followed by a fake out in a bearish bullish engulfing candle. But then the next day, we failed to break out of that bullish engulfing candle and actually broke below the previous day's lows. So for me, this was enough of a signifier that, hey, maybe we are losing momentum here. Again, we are using a variety of concepts, fair value gaps, but also the golden pocket, also liquidity concepts, also candlestick concepts, right? There are so many things to take into account here, and you don't need to learn everything, but the more tools you have that are back tested, that you can rely on, that you are confident in implementing, the better. So then we entered a short here once we failed to break out of this engulfing candle. And my hope was that we would get to at least the 0.5 fib level, which is the green level here. And the ultimate profit target would be if we close this gap. Now, we don't need to close the gap. Eventually, I think we will, but we don't need to close it with this down move here. However, I wasn't confident in when this move would happen, which is why I didn't go with something like options, because options lose money, right, over time if the move is not made. That is one of the main issues with options, is that if you're not expecting the move to happen quickly, that option is going to lose premium and you are going to lose money. So I expected there to be a down move. I just didn't know when. I didn't know if we'd hang out here for a very long time or not. And options were already expensive. So I didn't want to risk it with options. So I just shorted the shares outright, and I shorted at around 178 or 179, somewhere around there, when this candle was formed. Now let's look at where my stop limit was. My stop limit was at 191.15. And my take profit was, the first take profit, like I said, was at the 0.5 fib. So this take profit gave us a risk to reward of about 1.16 to 1, which is, as I told you previously, my minimum is 1 to 1. So I had my stop limit above this candle because, to me, if we closed above this candle, then this entire trade would be invalidated and we could continue up. I didn't need to put my stop limit way up here. We eventually rode this down to the 0.5 fib level and took partial profits. Now, what had happened was that we did see a bounce because Meta announced some AI breakthroughs, and we were actually getting very close to our entry on this day here. So as I said here, for risk management standpoint, I would close here at break even. Now, entering is one thing, taking profit is another thing, but managing your risk is another, right? I was not willing to hold this position and let it bleed past my entry. I wanted to, because I secured half of my profits here at the 0.5, if the price kept going up, plus I saw that there was an insane number of calls being bought on Meta, meaning that insiders were likely betting on the future of this AI breakthrough. I didn't want to just hold this position bleeding for no reason, especially since I made a nice profit off the initial move. So I ended up closing the other half at my entry, at break even, not losing any money. And lastly, I will give you my entry on Quantumscape. Quantumscape is one of these meme stocks from 2020 that ran. I think Quantumscape was trading at 160 at one point. It is supposed to be a battery alternative to lithium ion for EVs in particular. But Quantumscape also gained on earnings. I'm not entirely sure why. I think it's because the loss was narrower than expected. But you could see Quantumscape gain like 32%. It was also one of the heaviest shorted stocks going into earnings. So a lot of this could be a short squeeze. But if you look at the Fibonacci on Quantumscape, you could see a very similar thing here. Now, the next day following earnings, you could see that Quantumscape created what is called an inside bar. Some will call this a bearish harami. But if we pull up a Fibonacci, right, and we measure from the swing high to the swing low, you could see that this inside bar capped at the golden pocket. Additionally, I took a volume profile tool. This is in TradingView called the fixed range volume profile. And I went all the way back to that swing high Fibonacci to see where most of the volume lied at for Quantumscape. And it was right here around the $8.20 level. This is the point of control. This is where most of the volume happened for this range here. So when I took this short, I said that I was taking the short at around $10. I had my stop limit at above this candle because I didn't think that we would see a continuation from this insane, unnecessary, and irrational candle here. So I had it set at 12 and my take profit was around 8. Again, a 1-to-1 RR because I was risking $2 to make $2. And so far, the way that this has played out, we did hit near our profit target level. And I said that based on our risk to reward, you can take profit here or hold longer for a potential continuation after we see a bounce. Now, the reason I thought we would see a bounce is because, again, if you take a Fibonacci tool, you can see we bounced off of the 0.5, which is very typical. And I also stated that if you didn't want to short the stock outright, you can actually just sell the call spread, the 9-10 call spread, for 50 cents. And this is also a 1-to-1 RR because this is a $1 wide call credit spread. So if you sold it for 50, then your max gain is also 50. And percentage wise, that was up even more than just shorting the stock outright. But same reasons for Meta that I didn't want to trade naked options on it. One, they were very expensive. And two, because I didn't know exactly when the move would happen. I just had a strong bias based on the criteria that I talked about. And if I had to summarize and distill this into a few bullet points that one could follow, number one would be identify what bias you have in the market, what trend you see in the market. This is usually based on something like market structure. Are you bearish or bullish for the time frame that you are looking at? And then look at how to identify retracement points, valid retracement points, whether you're using the Fibonacci, whether you're using fair value gaps, whether you're using something like order blocks or even a moving average crossover or trend lines and patterns, supply demand. I don't care. There are many different ways of identifying valid retracement points, but your goal is to identify the trend. So if it's bearish, you are looking for retracements back up before taking a move back down. If it's bullish, vice versa, you are looking for movements back down or retracements back down before taking the trade that is going in your direction, which would be bullish. So that would be point number two. And then point number three, make sure you have at least two reasons why you're entering a trade. Make sure you have at least 2 points of confluence of that retracement point. And number four is stick to your risk to reward. If you are risking 10, make sure that you do not stop or take profit at less than 10 points. If hopefully your RR is at least 2-to-1 for a really optimal trade, but at the minimum, make sure that it's at least 1-to-1, no less than that. If this sounds like complete gibberish to you, then consider applying for the Academy, where most of the people that we have are in the beginning to intermediate stages. And we go over all of these techniques in our mastermind, such as how to draw liquidity concepts, how to draw supply and demand, how to identify market structure, what direction are we looking for the stock to go during intraday, how to trade options, how to trade futures, how to short stocks outright, etc. In my view, it is the most valuable trading community that you will find because we cover the full array of trading from charting to futures, options, etc. As I said before, I sound like a broken record now, but if you've got anything out of this video, leave a thumbs up and let me know that you find them helpful, and leave any suggestions for future trade recap videos. Would love to hear from you. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.